Well, ladies and gentlemen, it's 12 o'clock. Very good afternoon. Ladies and gentlemen, my name is Rob Milner and I'm Chairman of Washington H. Pattinson. I would like to welcome you to the 117th Annual General Meeting of this company. I'm advised that a quorum is present and therefore declare the meeting open. Before we proceed, I would like to introduce you to my fellow directors. Todd Barlow, Tiffany Fuller, Michael Hawker, Tom Milner, Warwick Negus, Rob Westphale, and next to Rob down there is David Gribben, our Financial Officer, and on my right here is Ian Bloodworth, our Company Secretary, and Melissa Alexander, our Company's Auditor, is here as well. I would like to thank all representatives from our investee companies who were responsible for their stands today. I hope everyone has found the displays informative and have had the opportunity to speak with the representatives, and I will introduce their senior management at the end of the meeting. You're going to see a different presentation today. We're not going to dwell on what we've done so much in the last 12 months, but I'm sure you'll find Todd's overview of the last 20 years and moving forward to the next 20 years very interesting. Following my address, Todd will deliver his presentation and then we will conduct the formal part of the meeting. Questions from shareholders and proxy holders are to be directed to me or Michael Hawker while he is chairing the meeting. Only questions relating to each of the resolutions will be taken at that time. General questions relating to the company and its operations will be taken from shareholders and proxy holders following the formal business. To ask a question, please come forward. You'll see the microphone here on my left and show me your blue or pink card. Before asking your question, please give me your name and the name of the shareholder that you are a representative, and we'll only take one question at a time. And please be advised that we have our mobile phones on silent or turned off. So the statutory profit and regular profit for the year were both about 7% lower than last year. However, as shown in the chart on the left, the regular profit increased by 60% in 2017 and 17% in 2018. And this year's result was up on 2017. While profit is one measure of performance, our primary aims are to achieve capital growth with increasing cash generation. The pre-tax value of the portfolio was marginally up on last year, finishing just shy of $5.5 billion. On the other hand, cash generation from the portfolio was very strong, up 18%. This is an important measure because the cash we receive in dividends and interest from our investments is what we use to pay dividends to you as shareholders. This growth in cash will facilitate continued higher dividends. The total shareholder return over long term continues to be very positive. During the year, we welcomed over 1,600 additional shareholders to your company. Since July, another 3,800 shareholders have joined the register, which is very pleasing. We were also admitted to the ASX 100 during the year, which reflects the growing liquidity and interest in the company's shares. Total shareholder return, or TSR, measures the share price movement and assumes that all dividends are reinvested. Our TSR underperformed the market over the year, but was still positive, returning 6.5. Unfortunately, we've faced some quite serious headwinds over the past 12 months, not for our doing, but various people from the ACCC right down to local governments, trying to give us approvals to move on with business and get things done. Particularly at New Hope, where we've had approvals in for 12 years to go to stage 3. We've been coal mining there for 100 years. The final appeal from the court came down about a month or 6 weeks ago, and before that the Premier of Queensland has said that she would give the project a tick when the court decision came down, and it came down in our favour. And again, 6 weeks, no action, and unfortunately we've had to lay off a lot of people. We're having the same problem with TPG. We took the ACCC to the federal court, so we're waiting for their decision. That won't be handed down till February. So we've had quite numerous headwinds against us, and it's not only in those businesses. Every other business that we're involved in, we've got someone telling us what to do, how to do it and when to do it. We expect volatility from time to time, and our aim is to outperform over the long term. As you can see in this table, we have outperformed in all other periods shown, including over 15 years, where the annual TSR is 11.6 per annum, 2.6 above the All Ordinaries Accumulated Index. The chart shows the return over 40 years, where the average TSR has been over 16% per year. This means an investment of $1,000 in your company in 1979 would be worth just under $400,000 at the end of July. While outperforming TSR is great for wealth generation, we all need cash to live. WHSP has an excellent track record of paying dividend and actively manage its portfolio to achieve its goal of paying steady and increasing dividends over time. WHSP has increased both its interim and final dividend every year since 2000. We are one of only 2 companies to do this, and the 500 odd companies in the All Ordinaries Index. Ramsay Health Care is the other one. Total ordinary dividends have increased from 10 cents per share in 2000 to 58 cents this year. The total dividends for the year is up 3.6% on last year. On Monday, we will pay the final dividend of 34 cents per share, which is fully franked. Dividend declared based on the company's regular cash inflows, less regular operating costs. This year, we will pay out dividends of 82% of net regular cash inflows from operations. On that, I'll hand over to Todd for his presentation.
Thank you, Rob, and good afternoon, ladies and gentlemen. I'd like to begin my presentation with a little bit of history. As we come to the end of the second decade of this millennium, it's timely to reflect on how far the company has come in the last 20 years. 2 decades ago, the share price was $4.10, adjusted for the share split, and the company had a market capitalisation of $978 million. At the end of FY19, the market capitalisation had multiplied over 5.5 times to $5.4 billion. In this time, dividends increased from 10 cents per share to 58 cents per share, and that represents a compound annual growth rate of 9% for 20 years. Regular profit after tax in 1999 was $45 million, and last year our profit had grown to $307 million, a compound annual growth rate of 10%. The annual total shareholder return over this period was 12.8% per annum, which represents about 4% outperformance against the All Ordinaries Index. This means that an investment in WHSP, where dividends were reinvested over the last 2 decades, has multiplied by 10 times, while an investment that performed in line with the index has multiplied just 3.6 times. Today, WHSP is one of the top 100 companies on the ASX, and I want to use this presentation today to talk about how we go about investing your funds and why we're just excited about the next 20 years as we are about the performance that we've achieved over the last 20. I'll cover our approach to investing, governance, the cross-shareholding, as well as sustainable investing. And then I'll talk about our major investments and finish off with some exciting news about some of the new investments that we've made. Over the past 2 decades, we've not really changed our philosophy to investing. WHSP has a diversified portfolio of uncorrelated investments across listed equities, private equity, property, corporate loans and cash. Our flexible mandate allows us to back companies at an early stage and grow with them over time. We aim to take a counter-cyclical and value-focused approach, and we aim to be a trusted partner that actively assists our portfolio companies in accessing growth capital and undertaking strategic mergers and acquisitions. As the Chairman pointed out, WHSP has a very positive and strong track record of value creation over multiple decades, and a very good track record of dividend growth. As long-term investors, we are sustainable investors, which means we think about the long-term viability of the companies and industries in which we invest. We value our reputation, we build relationships with the customers and the communities in which we operate, and we look after our people. Your company has a professional board of directors with deep experience across a range of industries and a good mix of skills. The majority of the board are independent non-executive directors recruited through a process designed to select the best possible candidate. WHSP's governance is compliant with the best practice recommendations, other than the independence of the chairman. The chairman is not considered independent by virtue of his long tenure with the company and large shareholding. We believe there would be few people more experienced as a chairman than Rob Milner, and his skills, experience and shareholding are key assets of the company. Rob has been chair of WHSP since 1999, which makes today his 20th AGM, and earlier I talked about the remarkable progress the company has made under his stewardship. As you might expect, WHSP runs a lean management team. There are just 10 direct employees of the company, predominantly involved in finance and administration. All of our transaction execution and strategic investments are carried out through our wholly owned investment bank, Pitt Capital Partners. And Pitt Capital Partners is actually a profit centre and last year generated $6 million profit after tax. The management of WHSP's large cap equities portfolio is carried out by Contact Asset Management, in which WHSP has a 20% shareholding. The cost of outsourcing the large cap equities management function to an experienced team of 7 people is just $330,000 per annum. We could not employ one experienced person directly for that amount, but more importantly, the management fee equates to less than 0.1% on funds under management, which is significantly below the cost of any equivalent market-based rate. WHSP is fortunate to be in a position to attract such a group of talented and loyal people who are focused every day on delivering outstanding positive outcomes for our shareholders. The cross-shareholding that exists between Brickworks and WHSP is unique in Australia, and that does not make it a bad thing. We regularly review the cross-shareholding and believe that the structure is working very well for WHSP. All of the evidence points to WHSP being well managed and governed, with the company consistently outperforming the index since the creation of the cross-shareholding in 1969. The cross-shareholding does not detract from performance and has facilitated a longer-term investment culture which has contributed to our outperformance. Despite all of this, there remains some common misconceptions about the cross-shareholding. Firstly, there is a misconception that the cross-shareholding creates governance concerns. The reality is WHSP is governed by a board comprising a majority independent, professional, external and highly experienced directors. Those that are not considered independent, Rob and Tom Milner, have significant family shareholdings in the business, which creates alignment, and additionally represent the 4th and 5th generation of family members involved in the governance of the business. Having a material shareholding drives shareholder alignment and focuses the company on building a sustainable business. Secondly, it is sometimes claimed that the cross-shareholding makes the company difficult to value. On the release of the half-year results and full-year results each year, we provide a simple table outlining the market valuations of each of our investments. Few companies on the ASX 100 would make it easier to value their companies than WHSP. The idea that the shareholdings each company have in each other are somehow illusory is wrong, and that was proven last year when Brickworks sold 8 million shares in WHSP for cash. Thirdly, there is a misconception that the cross-shareholding creates a valuation gap. We monitor this very closely, and in recent years there's a very close correlation between the value of the portfolio month to month and the share price. And fourthly, there's a view that the cross-shareholding creates difficult accounts. WHSP does have slightly complicated accounts, but it has nothing to do with the cross-shareholding. Having a number of associates and controlled entities within our portfolio creates some complexity when reading our accounts. However, that would not change if the cross-shareholding was removed. The relationship with Brickworks over the last 50 years has been a very productive one. It has added diversification to our portfolio and consistency to our dividends. WHSP has a proud history of focusing on our investors and delivering returns over the long term. Thinking, behaving and investing responsibly underpins this approach. Our core values are aligned with sustainable investing. We believe we are custodians of shareholders' wealth. We believe long-term and disciplined investment is the secret to our success, and we value our reputation. We believe that all of these values have contributed to the company's long-term performance. We also recognise the evolving expectations of our stakeholders in considering relevant environmental, social and governance, or ESG, related factors when investing with us. And for that reason, WHSP released in this year's annual report our inaugural sustainability report. WHSP has been a long-term investor in companies long before the concept became fashionable. Long-term investing, by necessity, takes into account sustainability risks. We invest in companies where we believe that there are long-term structural advantages, and we encourage our investee companies to also invest for the long term when considering capital expenditure or mergers and acquisitions. It's clear what our jobs are. We're here to maximise the investment returns on behalf of you, our shareholders. That does not mean we are blind to the concept of sustainable investing. In fact, we see sustainability as the single biggest driver of investment returns. Investing sustainably for the long term means caring about your people, the environment, your customers and the community in which you operate. We're often told that investment in coal is a sustainability risk. We have considered this risk very carefully. As the global economy transitions towards lower emission energy sources, it is likely there will be an ongoing demand for high-quality thermal coal to supply high-efficiency, low-emission coal-fired power stations in order to generate affordable baseload power. New Hope's high-quality thermal coal reserves are ideally placed to meet that demand. The International Energy Agency models 3 scenarios out to 2040 for global energy. The current policy scenario shows what would happen if the world continues along its current path, without any additional changes to policy. Under this scenario, coal usage for power would increase 19% between 2018 and 2040. As the world population and GDP grows and the 1 billion people without access to electricity gain some access. The second policy scenario, the stated policy scenario, incorporates today's policy intentions and the targets that have already been announced. Under this scenario, coal demand globally is essentially flat between now and 2040. The Sustainable Development Scenario maps out a way to meet sustainable energy goals in full, requiring rapid and widespread changes across all parts of the energy system. Under this scenario, coal demand globally would fall at a compound annual rate of 6%. The enormity of the challenge to meet the Sustainable Development Scenario cannot be understated. The scenario would require a concerted effort across the globe to decarbonise, utilising every bit of scientific and economic resources available. And the most recent indications are that most of the world is not even meeting the commitments modelled in the stated policy scenario. And it should be noted that when I talk about these figures, they talk about global demand. However, it's relevant to note that, firstly, demand in Asia, where Australia supplies its coal, will grow by much more than the aggregate, as the Asian populations and electricity intensity grow, while advanced countries switch to more renewables. And secondly, demand for Australia's clean coal will outstrip demand for high-emission coal from other jurisdictions. So as I said earlier, in the stated policy scenario, global coal demand is essentially flat for the next 2 decades. However, during that time, demand in India increases 97% and Southeast Asia increases 90%. Regional economic growth in Southeast Asia is forecast to triple in size by 2040, with energy demand predicted to grow by almost 2/3 in the same time frame. By the mid-2020s, India is projected to take over from China as the world's biggest importer of coal. And in India, the expected increase in coal usage between now and 2040 is 2 to 3 times the total annual current exports of coal from Australia. The other relevant factor in assessing the sustainability of coal production is availability of supply. Existing mines will eventually deplete all of their economic coal reserves or will come to the end of their permitted lives. In addition, new mine approvals and the capital required to invest in new mines are becoming increasingly difficult, These factors are already having an impact on the Australian coal market. Even in the Sustainable Development Target, where coal demand reduces significantly over the next 20 years, we predict that few mines, either brownfield or greenfield, would be developed. That would leave a scenario where demand for coal, particularly Australia's higher quality coal, will be greater than the existing supply. Under any scenario that we've modelled, or the IEA has modelled, we believe that Australia's coal exports will continue to receive strong pricing. And this is positive for any Australian supplier with low cost and long permitted mines. The higher cost and poorer quality coal mines will come offline first, and thereby provide price support to the remaining coal mines. And you can see on this slide that New Hope's Bengalla mine is low cost versus the operating costs of all coal mines globally. Bengalla is also permitted and expected to operate until at least 2039. New Auckland is also a low-cost mine relative to global coal mines, and we remain confident that its Stage 3 approval will come through. In summary, our view on coal is that it will remain an important component of the global energy supply under any scenario over the next 2 decades. We expect coal prices to be supported in this time, and Australian coal to fare better than the rest of the world, given its proximity to the growth markets of Asia and its superior quality. Remaining on sustainability, we believe that environmental management is a critical element of sustainability. As an example of the culture we promote in our investments, I'll talk a little bit about New Hope's environmental management. New Hope is an industry leader in rehabilitation of open-cut coal mines. Having a strategically considered mine closure plan is just as important as operating the site in a sustainable manner during its productive life. By sustainable closure, we mean leaving the area of our operations in a state that enables ongoing future viability. And that covers not only environmental matters, but people, community and assets. On this slide is a 2012 picture of the new Oakley mine when it was operational. And then on the right-hand side, 4.5 years later, after the operations had concluded, New Hope's rehabilitation of that land. New Hope does not wait until mining completes to rehabilitate the land. It uses industry-leading progressive rehabilitation techniques which have achieved considerable success in returning rehabilitated land to cattle grazing. New Hope runs pastoral operations on its rehabilitated land and conducted grazing and cropping trials. The results indicate that rehabilitated land performs at least as well as the undisturbed land in the local area. The New Auckland mine minimises its impact on the groundwater system by utilising recycled water from Toowoomba for use in its operations. This recycled water is the primary source of processed water for the mine site, as well as water sourced for the Auckland Pastoral Company property operations around the mine. New Hope's activities prove that mining and agriculture can coexist, and we as a society do not need to choose between agriculture and mining. As a long-term investor, we believe it's important to invest in the preservation of our reputation and the communities in which we operate. Community and charity has been a continuous part of WHSP's culture since its inception. Louis Pattinson, one of the company's founders and chairman from 1930 to 1945, donated the first aeroplane to the Royal Flying Doctor Service based in Broken Hill. And pictured here is the L.M. Pattinson aerial ambulance from 1940. I'm proud to say that your company continues to provide financial assistance to the Royal Flying Doctor Service and supports the Outback Car Trek. We also are a financial supporter of the Salvation Army. And this community involvement and charity has permeated through to WHSP's investments. Since 2010, API has raised more than $4.5 million through the Priceline Sisterhood Foundation for various charities involved in helping women and their families through serious illness. In the last 12 months, New Hope has provided approximately $2 million to local communities around Bengalla and New Auckland. And over the last 6 years, New Hope has also been a major corporate sponsor of the Life Flight Foundation, which provides medical evacuation services in Queensland. In the last 6 months alone, New Hope has donated over $1.1 million to the operation of the Life Flight helicopter, which saves hundreds of lives every year. I'll now provide an overview of our portfolio as at 31 July and talk about our major investments and then introduce some of those newer investments. As at 31 July, the value of the portfolio was just under $5.5 billion. The vast majority of assets in the portfolio have market values as a result of being listed on the stock market. The private equity investments and property assets are valued by the board, and we've been conservative in our approach. Many of the valuations are simply what we paid for the asset. Over the year, the gross value of the assets grew by $31 million or 0.6%. The increase in the value of our holding in TPG Telecom was offset by a decrease in the value of our holding in New Hope. The Round Oak Minerals asset increased in value as a result of continued investment rather than an increase in valuation. And similarly, our property portfolio decreased in value by $93 million as a result of sale of assets, not because of decreases in value. The major sale that occurred during the year was the head office property at 160 Pitt Street. At year end, our investment in TPG was worth $1.64 billion. And this has obviously been an excellent investment for us over the years. There's no doubt that the construction of the NBN, where the government has forced consumers to switch to the NBN infrastructure, has impacted the company negatively. Despite the migration in FY19 impacting TPG's EBITDA by $60 million, TPG was able to grow other parts of the business to offset that margin loss. In FY20, the migration of customers to the NBN will continue, and for that reason, TPG has given guidance that its business as usual EBITDA will be down 10%. Once that migration to the NBN is complete, TPG can begin growing again. TPG applied to the Federal Court for approval to merge with Vodafone. We believe that a merger is very beneficial for shareholders because there are lots of synergies created and the two companies are very complementary. We also believe the merger is good for competition because the merged entity will be well placed to compete with the two dominant players in the industry. A decision from the Federal Court is expected sometime in the next few months. New Hope had a reasonably good year. Regular NPAT was up 3%, which was mainly due to an increase in volumes at Bengala and offset by falling volumes at Ackland as we near the end of Stage 2. Cash generation from operations was strong. It was up 17%. That led to higher dividends, and the dividend contribution to WHSP was up 22% on the previous year. During the year, New Hope acquired a further 40% stake in Bengala. Bengala is a long-life, low-cost and high-quality coal asset. It has the longest permitted mine life in New South Wales out to 2039. Unfortunately, after 12 years, we still await approval for the new Ackland expansion. There's no impediments to the Queensland Government giving the final approvals. However, their delay, unfortunately, has meant that New Hope has ramped down production and made 150 new Ackland employees redundant. Activist groups have challenged New Hope in the courts at every stage. The engagement of lawfare as a tactic is an unfortunate reality of the approval process for resource companies. New Hope's opponents are committed to causing maximum delay and increasing the costs of the approval process. These tactics have resulted in the loss of 150 people's jobs, reduced economic activity in the region, created a huge amount of uncertainty and anxiety for shareholders, employees, contractors, customers and those in the local community who rely on New Hope. But we remain confident that New Hope will ultimately prevail in receiving those approvals. Brickworks had a record underlying profit for FY19. This strong result was driven by strong profitability in the property division, where revaluations on the industrial property assets and land sales contributed to a 68% increase in EBIT. The building products division was impacted by increasing energy prices, as well as a downturn in construction activities across all states other than Tasmania. As a result of shortages of domestic gas supply, Brickworks' cost of gas has increased by approximately $25 million per annum over the last few years. However, in FY20, Brickworks has entered into wholesale gas arrangements, which should see a material reduction in the price of their gas. The Brickworks Industrial Trust has large parcels of undeveloped land which are in high demand and should provide continued development opportunities for years to come. Thank you. In FY19, Brickworks entered the US market with the acquisition of the Glengarry business. They then followed that acquisition with Sioux City Bricks and Redlands Bricks. And that will strengthen and consolidate their presence in the market. The growth prospects in the US market are very strong, and this strategy represents a very exciting new opportunity for Brickworks. During the year, we spent quite a bit of money at New Hope, at Round Oak, I should say, and the losses impacted our results. The regular loss of $54 million was a result of start-up development expenses at new projects, delays at our North Queensland assets caused by some extreme weather in the wet season last year, and a reduction in volumes at Jaguar in Western Australia as we realigned the mining sequence and opened up new mining fronts. Some parts of the business have underperformed expectations, and commodity prices were not as high as we expected. The threat of trade wars and falling global GDP growth has weighed on copper and zinc prices throughout the year. However, we remain confident that the supply-demand characteristics of the copper market should increase prices in time. In FY20, we will see production commence at Mount Colin and Barbara in Queensland, and we're continuing to produce at Jaguar in Western Australia and actively seeking to extend the mine life by opening up new underground mining fronts. We'll also be progressing our mine planning at Stockman in Victoria, which is a long-life, high-quality asset. So since 31 July, WHSP has entered into a couple of new investment industries where we see attractive fundamentals and we can partner with good operators to expand with further investment. We've acquired a high-quality, diversified portfolio of land and water-based agricultural assets across Australia. The portfolio produces a range of commodities, including citrus, macadamias and cotton, all of which are commodities where Australia has global competitive advantage, stemming from our low cost of production, high product quality and ability to deliver counter-seasonal production. The portfolio is in the process of a comprehensive redevelopment plan which is expected to result in a material lift in productivity, profitability and value. And WHSP has entered into an arrangement with Argyle Capital Partners to manage these assets on its behalf. Argyle is a leading agricultural asset manager with a strong track record of delivering value in a diverse range of agricultural enterprises. And we've invested about $100 million to acquire the portfolio and will continue to explore further opportunities in the sector. We've also recently formed a new joint venture to build and operate luxury independent living accommodation for retirees. Our joint venture partner, Provectus Care, was established by Dr. Shane Moran, who is one of Australia's most respected aged care and retirement living operators. The pictures on the left of this slide show an example of the quality of the product being offered by Provectus Care. These are pictures of the recently completed project in Wahroonga called The Rose by Moran. Not only are the apartments finished to a very high standard, the development offers residents access to facilities such as a pool, gymnasium, cinema and wine cellar room. WHSP and Provectus Care will work together to acquire new sites to develop and manage premium independent living residences. The first site we have acquired is a block opposite the beach in Cronulla to be called Sage by Moran, and the concept drawing is pictured here on the right. We believe there's very strong demand for this product and we're excited to be partnering with Provectus Care on this strategy. Finally, I'd like to thank my fellow directors for their contributions and support throughout the year. Thank you to all of the WHSP employees who work hard every day to manage our shareholders' money, and to all of the leadership teams of our underlying investments, many of whom are here today. Thank you for your hard work and for putting up with our relentless request for greater performance. And to all of our shareholders, thank you for your ongoing support and for putting your faith in us to manage your investment. I'll now hand back to the Chairman for the formal part of the business.
Thank you, David.